First up, being able to invest in high quality companies at extremely cheap prices requires investors to have a long-term investment horizon and the ability to see through the fog posed by temporary economic headwinds. The absence of certainty is one of the key features of this type of investing, and this was one of the myths asset manager RCM addressed in a recent press release. Linda Eads joins us in studio to give us more insight on these issues. So let's start with the belief that where you've got good economic growth, you're going to see good investment returns.
Yes, well, that is a commonly held belief, and it's really sort of derived from the fact that the fundamental value of a business should grow where there is economic growth in a region. But the unfortunate thing is that market prices and the value of businesses tend to differ substantially, and that's got a lot to do with sentiment. So where sentiment is very positive, where economic growth is expected to be very good, prices tend to be too high. They tend to run well ahead of what the value of a business is. And the converse happens where economic growth is expected to be poor, where prices are very low, and from that point you're sure to get a better investment outcome than the expensive prices. So the latter is where we really look for investment opportunities.
So there must be many investment opportunities for you in Europe at the moment, for instance.
Indeed, yes, absolutely. In Europe and in other parts of the developed world, which is obviously expected to grow less than sort of its history over the near term, and certainly less than the emerging markets as it has done. So in Europe in particular, we still invested in some of the retailers, for instance, and we started looking at this area and those companies about a year and a bit ago, sort of the end of 2011, beginning of 2012. And one we identified was Carrefour, one of the biggest retailers in the world, second after Walmart, in fact. And it was trading at a price so low that it was indeed below its property book alone.
So up 35% in dollar terms.
That's right.
Over the period
That's
that you
right.
hold it.
And one of the interesting things to note is that if you buy businesses that are cheap and there's a lot of negative sentiment, in the short term you can see that price moving further down. Now the difference between that price decline, a business that's cheap that becomes cheaper in the short term, and the price decline you get from a very expensive business where expectations are too high and prices fall from those levels, that's a permanent loss of capital, whereas the investment opportunity that's cheap, that gets cheaper, is a temporary loss of capital, and that's in fact what happened with Carrefour. It fell by about 20% over the course of the year in the first few months, and it's up about 70% since then. So since the period we've held it, it's delivered good investment returns, and we actually still think there's more to come. There's still a discount to the fair value.
Warren, you have to jump in because with Linda and I, you're not going to get a word in edgeways.
We're talking about shopping already, so I'm just going to continue along that line. Linda, obviously you love buying quality companies, so how do you what's the sort of metric for setting aside a quality business from a not quality business? Because often we can be, confused with a big company being a quality business. So I'd be interested to see how you define the difference between the two.
Well, what we would constitute a good quality business is one where we look at the track record of the business in terms of its ability to deliver a return on capital over and above its cost of capital. Now, if you've got a business that has done so historically, it typically means that they've had some kind of barrier to entry, some sort of sustainable competitive advantage, which has enabled that. Otherwise, the returns obviously drift sort of closer to the cost of capital over time when competitors come in. So that's what we're looking for, the history, as well as being able to, in many ways, more qualitatively identify that barrier to entry as being permanent in nature. So in other words, that will continue to be the case into the future. So all of the quality businesses, by our criteria, share those sort of principles.
Now, obviously with quantitative easing and very low interest rates, it distorts things somewhat because the cost of capital is very cheap in the developed world. So for a retailer like Carrefour, how do you just make sure that you're not being misled by the situation at the time? And in the last 5 years, that's been quantitative easing.
Yeah, absolutely. I mean, what we tend to do is rather than sort of use the current situation today, whether it's interest rates and the likes, and sort of use that as our basis for the cost of capital, we tend to look at the long-term history and the required return that we would demand from a business of that nature. So, when we're looking at earnings, when we're looking at revenue, when we're looking at the cost of capital, we're always trying to look through the cycle. So beyond the sort of short-term horizon, and that kind of takes away some of the noise and distraction of trying to anticipate things over the near term where you quite frankly have a good chance of being wrong.
Another thing that you highlight in your philosophy is that uncertainty is in fact your friend and not something that should be avoided.
You know, a lot of investors have to worry about short-term uncertainty, and the reason for that is that they have an investor base or a track record where they are very preoccupied with how they perform in the short term relative to, for instance, their peers or any particular market index. The unfortunate thing about that is that if you have to worry about short-term volatility, it prohibits you from sometimes making good long-term investment decisions. So what we tend to do again is our investors hopefully understand that we are making good long-term investment decisions, and as with the case of Carrefour, as with many of the businesses that we invest in, there may be some temporary short-term volatility, but ultimately our investment thesis is based on a good long-term investment outcome.
I think a fascinating pick, and we're talking about the RECM, one of the RECM funds here is your holdings in Amplat. You've held that position for some time, as I understand it, and it's obviously under the condition, the way I understand your thesis with it, is that you're investing in Amplat because you believe at some point the platinum market will get better, and the company will be able to control costs in a better degree than it has of its recent history. So in effect, it means that you're investing without seeing any projection or forecast. There's not a lot of certainty you can attach to it. It's more an assumption. Would that be a correct way of describing it?
The way that we assess Anglo American Platinum as an investment opportunity is, first of all, many people would say it's a poor quality business because it's got all these issues surrounding it at the moment, and it's not able to meet its costs at the moment. The platinum price is below the marginal cost of production, when in actual fact what makes it a quality business is that it actually has a track record of demonstrating the ability to produce very good returns over the cost of capital over time. And it has a permanent barrier to entry by virtue of sitting on the majority of the world's platinum reserves. So the thesis is based on the fact that if you have a platinum price which is below the marginal cost of production, and you assume that that demand is going to persist into the future, so we're not going to all start driving electric cars tomorrow. There is still going to be a demand on the AutoCAT side, as well as jewelry demand coming out of China, which is almost overtaking AutoCATs, interestingly. Then at some point, someone like Amplat, which is sitting on the world's reserves, a big chunk of it, will have the ability to price above that marginal cost of production. What has to happen for that to take place is supply has to contract, production volumes have already fallen, the small players go out of business because quite frankly they cannot withstand the pressure. Supply contracts and demand at some stage, which is at a cyclical low, picks up and you have a normalization.
And you don't try and time this. It is going to happen when it happens.
It's a capital cycle adjustment. We can say where we are in the cycle. What we can't say is how long it'll take for that to play out. And again, that's with regards to the share price, because often the share price actually tends to run ahead of the fundamentals coming through.
So where are we in the cycle when it comes to?
Well, we're at an absolute low. We don't know about the share price. It could actually continue to go down further,
and that would be a temporary capital loss in your view.
Correct. But what we would say about the platinum supply-demand situation is that the numbers are just about to come out, and we anticipate that for the first time in a few years there'll actually be a deficit. So the demand for platinum will actually outstrip the supply.
It's a convincing argument, Warren. Are you finding other fund managers are also starting to look at Amplat?
Well, I know all the deep value managers are in Amplat and Anglo American PLC, so there's a lot of investment in the resources, but it's getting your head around being able to, I think, invest in this uncertainty because you can't project it, and analysts and portfolio managers love to take out spreadsheets for 30 years and estimate the likely outcome of earnings and that sort of thing. So to do that in an environment that's very much in flux is hard to do.
I think, the thing is that you've got two choices. Either you can say where you're in the cycle and you can base your investment decision on that, knowing not how it's going to play out, or you can do what a lot of market participants do, which is, as you correctly say, try to forecast a business's earnings and revenue over the next year or two. Say, is my forecast better than or worse than consensus, and what does that apply about what the share price is going to do? The reality is that the track record of forecasting even 1 year out for analysts, they get it right just over 50% of the time. For 2 years, the track record is something like a third of the time. So rather than wasting your time trying to forecast a market price, which is so sentiment driven, you really are sort of wasting resources in our opinion. Rather base your investment decisions on something you can accurately measure, where you are in the cycle and how that is likely to play out.
Is a good quality business always going to be a good investment decision?
No, absolutely not. And that happens quite a lot. People will say if you buy a good quality business and you just hold it over time, it's going to be a great investment.
Like a ShopRite, for instance.
Like a ShopRite, or I like to give the example of Microsoft, because at one point in time, this share was immensely popular. At the time of the tech bubble, it was at a PE of 84. It fell by 63% after that. Great quality company, poor investment at that point in time. Today, lots of negative news about PC sales declining, etc. Still a fantastic business, which is got pricing power, strong barriers to entry, today at a normalized PE of 10. Today, a quality business and a good investment.
Linda, before you go, we've seen in this portfolio that you hold 14% of the portfolio is invested in Japan, and Japan's a very interesting place, I guess you could call it. Lots of news around Japan. Tell us about some of the opportunities you've been finding there, because I think it's very much an unfavorable or unfashionable place to be investing at this point.
You're quite right. We have two exposures to Japan. One is through the Chirizuko Fund, which is essentially a fund. We've partnered with another asset manager in Tokyo who's been there for 3 decades, who actually looks just at small caps, which is a very ignored and neglected market. More than 1,000 companies are not at all covered by sell-side analysts, and which happen to be very cheap precisely because of the bear market. Now, we can't speak Japanese, we can't invest directly. They do that for us. We saw a great opportunity. We wanted to take part. We invest directly in large caps such as NTT Docomo, which is the biggest wireless operator, telephone operator in that space. And there, the business has shown, again, a track record of delivering very good returns on capital. And the market is, sort of not looking at Japan as a potential investment opportunity. And you've got wonderful, high-quality businesses trading very cheaply.
We've got another introduction, and we've only got 1 minute left, but we have the moment of truth. So I'm going to ask you, since you've been at RCM, what has been the very best investment decision that has been made?
Well, I think that a great example of the way that we invest and the benefit of it has been investments in the Greek market. A year ago, we looked at that market. People thought we were crazy. We found high-quality businesses, Coca-Cola, Hellenic exchanges, which were trading at incredibly low prices. They've both done incredibly well from those levels, and that just shows the benefit of going contrary to the crowd.
All right, now the tough one, the worst investment decision.
Well, I have to say on the local front, it has to be Telkom. We invested in Telkom. It was a low-quality business. We put in deteriorating fundamental assumptions. Unfortunately, we weren't pessimistic enough. And as it turned out, we had to revise our fair value calculation. And we found that at that point in time, it was not a good investment opportunity.
Linda, thanks so much for your